So are you feeling overwhelmed by your mortgage or your loan payments and wondering if a refinance makes sense? Or how does even a refinance actually works? And should you even be considering it right now? So in today's video, we're gonna walk you through a clear, practical guide to refinancing. We'll cover what an actual refinance is. We'll go over the pros and cons, when you should do it, when you should not, and the real cost that you need to know before you make your decision. Now let's get into it. So a refinance is just the process of replacing your current mortgage with a whole new loan. And you're actually going to be paying off your current mortgage and starting up a new one. In the new loan, the purpose or the benefits of doing that, you can change your interest rate, you can change your loan amount, you can change the actual terms. You can go from a 30-year to a 15-year, go from a 15-year to a 30. You can also go from an FHA to a conventional and change the actual loan type itself. And you can also pull money out and pull equity out of your house. And here are a couple reasons why someone would want to refinance. Number one, if it helps lower their payment. So if interest rates are lower today than when you bought the house for, then you could refinance to a lower rate and that will lower your payment. A lot of people that have 7%, 8% interest rates that bought 3 years ago are now doing refinances and saving a lot on the monthly payment. Also, if you want to extend the loan terms, let's say you have a 15-year and you want to go to a 30-year or 28-year, that's another way that will lower the payment as well. And two, if you want to improve the loan terms, so let's say that you started with an adjustable rate mortgage and it adjusted higher to the fixed rate right now, you can switch from an ARM to a fixed. You can also shorten your loan term as well. Let's say you have a 30-year or a 25 years left on your mortgage and you want to switch to a 15-year to pay off the interest a lot faster. That's another way. And also, you can access your equity and you can pull cash out of your house itself. And you can do this for a number of different reasons. If you want to pay off any debt that have a high interest rate, any credit cards, student loans, things like that. Also, if you want to do renovations or if you want to invest, or if you are going through a divorce or you need to buy out your partner, that's another way that you can do a refinance to pull the cash out of the house and give it to them. And here's how a cash out refinance works. So let's say you have a loan amount of $200,000 and your house is worth market value about $400K. You have $200,000 worth of equity that you can access by doing a cash out refinance. Now the thing is when doing this type of refinance, you will have to requalify for the new loan with the new loan amount. So they're gonna look at your credit, they're gonna look at your income. And when people normally do this is if they want to pay off a large lump sum of debt, like credit card, student loans, or debt that has a high interest rate, that's a lot lower interest rate than what you would get on the house. Two, if you want to invest in other real estate, buy another home, or invest in other opportunities as well. And three, if you're going through a divorce or a partner buyout, you can split the equity, do a refinance, give that person the money. The bank doesn't necessarily need to know what you're using the money for because again, that equity is ownership for you. Here's what a rate and term refinance is. You're just changing the terms from the old loan and really, you're not accessing the equity, you're not taking any cash out of the property. And the benefit of doing this type of loan, let's say if interest rates are lower today than when you bought the house for, you could do a rate and term, lower the interest rate, lower the payment. You could also change the terms of the loan. You could go from a 30-year to a 15 or vice versa, or you can switch the entire loan as well. Let's say you started with an FHA loan, you could go to a conventional and remove that private mortgage insurance. And when people normally do this is again, if rates are lower, if they want to pay off the home a little bit faster and not pay as much interest, so they go from a 30-year to a 15-year, or if they want to remove a person off of the mortgage, but they're not going to buy them out, that's when a rate and term would be more beneficial. And here's how an FHA streamline works. So it's the same thing as doing a rate and term refinance. This is just a specific product related to FHA. So let's say that you currently have an FHA loan on your home and interest rates, today's rates are lower than what you currently have. You can do a streamline, lower the interest rate, which will lower your payment. And the benefit of doing this specific product is, number one, there's no appraisal that's required. Also, you don't need to requalify for this type of loan as long as you've been making your payments on time. They don't even look at your income docs. They don't care if your income has decreased since you originally bought the house. They don't even look at if you currently have a job. Just as long as, again, you've been making your payments on time, They will look at your credit. A lot of times they'll do a soft pull, and it must be at least a 620 plus. And then they're also going to ask you for a current mortgage statement, and they're going to ask you for the original note on the house, the note you got it on the day of closing. So it's a really easy, very simple, it's streamline, that's why they call it streamline type of loan. And you have a VA streamline, or also called a VA IRRRL, an interest rate reduction loan product, which is the same thing as doing a rate and term, but this one is specific to a VA loan. So let's say you currently have a VA loan on your home, and today's rates are lower than your current interest rate. You can do a VA IRRRL, lower the interest rate, you lower the payment. And the benefit of doing this type of VA IRRRL product is there's no appraisal that's required. You don't have to provide any type of income docs. If your income is drastically lower, or if your job has changed since you bought the house, they don't care. They don't verify income at all. And they really care that you're making your payments on time and that your credit score is still in good shape, at least a 620 plus. So they're going to look at your credit. Also, they're going to ask you for your mortgage statement and the original note as well. And the main thing, this is a very simple, fast, easy process because, again, no appraisal and no income docs. And here's some of the cost breakdown of doing a refinance. And there is always going to be a cost to refinance, even if your lender is telling you otherwise. So number one, you have lender fees. It could be underwriting fees, it can be discount points, the amount they charge to get that specific rate they're giving you. And also there could be some admin and some processing fees. Two, there's always going to be third-party fees. So if you need an appraisal, that's another fee. There's going to be the title company is still going to have to relook at the docs and reissue title docs as well. Also, there's a fee to start up your escrow account again, which is paying your property taxes in advance to make sure you have a cushion in that escrow account, and also a credit report as well. And you can roll these costs into the loan, or you can pay them out of pocket. And if you're rolling them into the loan, you just have to make sure there's still a benefit of doing the refinance and the cost doesn't outweigh the benefit of doing this. And this right here, when they roll it into the loan, that's why a lot of companies advertise no closing costs. A lot of times, again, they're rolling it into the loan, so you yourself might not be paying it out of pocket, but you're paying it within the loan amount. And here's one of the most important factors when it comes to deciding if a refinance, you should do it or not. And it's called the break-even point. And this is just figuring out when the cost outweighs the benefits of the refinance. So how you'll determine it, let's say your closing cost or the cost to do it is about $3,000. And let's say you're saving about $100 a month on the refinance. So that means that's gonna take you 30 months to recoup the cost, the $3,000 that it took to do the refinance. And the question that you'll wanna ask yourself is, will I stay in the property for that amount of time? If the answer is yes, then there is a benefit of doing the refinance. If the answer is no, let's say you're going to be selling the property in 24 months or 12 months, then the cost outweighs the benefit of doing the refinance. And here's some of the biggest red flags you want to watch out for when even considering doing a refinance. Number one, no closing cost advertisement. Again, there's always going to be a cost associated with a refinance. And a lot of times they do this just to pull you in, to get you on the hook, and it's either rolled into the loan or, again, you can pay it out of pocket. Number two is resetting the loan terms. So let's say that you started out with a 30-year mortgage, you're 5 years into that 30 years, so you got about 25 years left. And a lot of people don't realize that you don't have to refinance back into a 30-year. There are a lot more flexible options and flexible terms you can go from 25-year to a 25-year. There are options as well. So don't think that you have to go back to that 30-year. And also not doing the break-even point and not knowing how many months it's going to take you to recoup the cost of doing that refinance. And if you're thinking about refinancing and want my help in knowing what your options are, click on the link in the description, schedule a call, and I'll be in touch.